Good day, everyone. Thank you for joining us once again here at S&B for our webcast. And for this webcast, we're going to be reviewing over the community bank performance for the fourth quarter of 2022. But before we get into that, just want to make a quick note that as of the beginning of 23, Seafried & Brew is now part of Veligan Blaxel Consultants, LLC. And you'll learn more about that on our website. But for this webcast, let's focus on the performance of that community bank benchmark group. And the first thing we want to look at is that growth rate. Overall, when we look at assets grew at a 1.66% for the fourth quarter. That's that quarterly growth rate, a little higher than when we saw in the third quarter at 1.26. In terms of loan growth, loans grew at a total of 3.76%. Net out those PPP loan payoffs, and we can see that growth rate is 3.8%. Continue to be a solid growth rate, but lower than what we saw in the third quarter. And that's just continuing to be reiterated throughout our meetings in 2023 that loan production will be down throughout the year. And this just continues to reiterate that. Now, on the deposit growth, notice here deposits are up just 0.32% in total, a slowdown from where we were in the third quarter at 0.86. But not only that, when we strip out the broker deposits, we can see here actual non-broker deposits declined by 32 basis points. So we saw a reduction in those non-broker deposits, whereas last quarter we saw an increase of 0.35%. So we start to see this runoff of some of these deposits, and most of our institutions are seeing that throughout the first quarter of 23. And we see that as an industry-wide, when we look at the total deposits for all commercial banks, we start to see this downward trajectory in this level. And that started at the beginning of the second quarter in 22. We started to see this kind of level off and come down. Now, of course, we're still at a much higher level than the trend growth that if we were to continue to see that trend go throughout this time period because of that surge in deposits. So that surge in deposits still remains above $2 trillion at $2.2 trillion. Now that's down from where it was in our last webcast at 2.7. So we see a definitive decline in that overall level of deposits in commercial banks. And that's just going to continue as we move throughout 2023. In terms of performance, ROA remains solid above that 1% level, but does come down quarter over quarter from 1.18 in the third quarter down to 1.14. So just pulling off 4 basis points. Now, when we look at the subgroups inside this community bank benchmark group, if you recall, those are the subchapter S institutions, the stock institutions, and then those mutual institutions. So when we look at the sub S and the stock, we see their ROA both declining slightly from a 144 to a 137 on the subchapter S, and the stock institutions coming down from a 112 to a 109. Now the mutual institutions here remain the same. They leveled out at that 0.66 from where they were in the third quarter, and we came in the same level in the fourth quarter. Year over year, when we're looking at that fourth quarter performance for 22 versus 21, improvements across the board. A lot of that improvement that we saw year over year came from that net interest margin. We can see in the fourth quarter, net interest margin averaged 3.61% compared to 3.21 back in the fourth quarter of 21. But notice this trajectory that we saw, this increase throughout 22, has begun to slow down, where we saw just a 10 basis point increase in that net interest margin quarter over quarter. And that has to do with the dynamics of the components of net interest margin. We can see here yielding earning assets continuing to run strong, increasing quarter over quarter for the past 4 quarters, tremendous increases. And that's continuing to support that growth in net interest margin. When we look at the cost of funds, we've seen that the change in the cost of funds escalate in here. Notice, in the first quarter to the second quarter, up only 2 basis points from 24 basis points to 26. And then we had an 11 basis point increase between the second quarter of 22 and the third quarter of 22. But look here, between the third quarter and the fourth quarter, up 27 basis points on that cost of funds. And we're going to dive a little more into that in just a minute. But looking at that yield on earning assets, we know the dynamics of the asset side of the balance sheet has been changing, particularly when we look back pre-COVID to 2019. The net loans and leases to overall assets have been growing throughout 2022, reaching up to that 62.37%. That compared to where we were at the end of 21 at 57.49%. But we're still lagging from where we were pre-COVID when we saw that level reach 66.34. So we'll most likely continue to see this trend of increasing in the overall loan portfolio. That's going to support that higher level of earning assets. Now, that cash balance continues to decline from where it was above that 10%, even above 11% in 2022, and just started to move down. And now reaching levels of 5.65%, more normal to where we were pre-COVID. But the dynamics here are changing, and that's going to support that overall higher level of the yielding earning assets, and hopefully stave off some of the negative pushback from those deposits. In terms of the cost of deposits, we looked at cost of funds before. We saw that increase. We're seeing even greater increase when we look at the cost of interest-bearing deposits. You can see quarter over quarter going from a 47 basis points up to 78 basis points. So you're looking at a 31 basis point increase. That's a substantial increase. In fact, you look back to the first quarter. In the first quarter 22, we only had 31 basis points as our overall level of cost of interest-bearing deposits. So we've already doubled that level, and that's just in one quarter. When we compare the cost of interest-bearing deposits to the overall level of the Fed funds rate in those tightening type of environments back in 2005 through 2007, and then 2016 to 2019. When we look at the correlations and the spreads between the net interest, the cost of interest-bearing deposits and the Fed funds rate, you can see on average during those tightening periods, the spread was about 1.03%. So that means if we anticipate the Fed funds going to that 5% level, we can look at a potential cost of interest-bearing deposits at about 3.97%. That's a far cry from where we are today, even with the increase in overall cost of interest-bearing deposits at that 78 basis points. So that's just something to be aware of. When we're thinking about budgeting, we're thinking about those overall levels of cost of our deposits. It's going to become very important now. We start looking at that marginal cost of funding. when we think about increasing deposits or creating new deposit accounts in order to absorb some of that runoff. So that's something to keep in mind. When we're looking at in the fourth quarter state to state overall averages for your cost of interest-bearing deposits, you can look at this map, find your state, and see what the average cost of interest-bearing deposits were for that community bank benchmark group in your state. And we can see the highest level in Rhode Island at a 153, and the lowest level is at a 0.3. So that's what we want to keep an eye on, where we are, where your bank is compared to that overall level of the cost of interest-bearing deposits. In terms of efficiencies, we continue to see, as we saw throughout 2022, this ramp up in the overall level of net overhead. Remember, net overhead is the difference between non-interest expense and non-interest income. So the lower the number, the better, and we've seen continue to see increases up to 1.97 in the fourth quarter. That being said, looking at the components, we can see that we're being impacted on both of the components. Cost of operating our institution, that non-interest expense, continues to increase, going up to 2.5% in the fourth quarter. Now, the fourth quarter, we typically see that happen, a little bit of a spike, because of just a change in the overall level of salaries and certain expenses that hit in the fourth quarter. So we see that spike. We would anticipate in the fourth quarter that number to come down, or the first quarter that number to come down a little bit. But we have seen this negative trend in the non-interest income continuing to move down as a percent of average assets. Moving from where we were in the fourth quarter 21 at 52 basis points down to where we are in the fourth quarter 22 at 44 basis points. So that's just a continual downward trajectory, because the big number back previously was a lot of loan sales, and that produced a lot of non-interest income, and we're just seeing that category much lower this year than we have seen in the past couple of years. So that's pulling that off. Overall, when we're looking at risk continues to increase. We saw that throughout 2022. We're now above that 50 mark on our risk score scale. Puts us into that moderate, close to upper moderate area. Breaking this down to the four primary components, capital risk continues to run a little hotter just because of the overall level of those capital ratios moving down. But credit risk has remained relatively low throughout this time period, and that's the big question. If we do find ourselves in a recession over the next 12 to 18 months, will it be deep enough to impact that credit and start to push that credit risk up? So we'll continue to monitor that. That hasn't been the case so far. Liquidity risk, though, as we know, has increased throughout the year, and we've seen that reflected here with the overall cost of funding going up, as well as some of that funding leaving and giving us the need to access those wholesale markets for the funds. So that continues to move. And then earnings at risk kind of leveled out, still remains fairly high just because of the sensitivity of that net interest margin, and now the risk that we see the shorter rates on those deposit costs moving up, impacting the overall level of earnings throughout the next 12 months. Well, that's what we have for you today in terms of that community bank benchmark group. Overall, a solid quarter in the fourth quarter with that positive 1% plus ROA, but we do start to see items that are getting us a little more nervous in terms of the cost of funding and the overall liquidity issue that we're beginning to see creep into our institutions. That's what we have for you today. Have a great day, everyone.